Taking a look at the current account deficit here in South Africa, narrowing more than expected to 3.2% of GDP, and that's from 7% of GDP in the first quarter. So quite a big improvement there, and not surprising considering that the trade balance numbers were also better when they were released on Monday.
Very much. We remember that a lot of the deficit came from the capital investment. You know, a lot of the equipment that went to Gautrain, into various road infrastructure, including Eskom turbines. So therefore, going forward with investment coming down due to its successes or its implementation, we should see it coming down. But more encouraging is the fact that we're beginning to see signs of steel prices picking up, and therefore there are brighter signs that maybe manufacturing in the first quarter of next year could start picking up due to some pent-up demand that was seen coming particularly from a few countries, but not yet there yet.
Taking a look at the vehicle sales that were released, down 26.2%, but much better than the contraction of 27.4% in the previous month. Is that not going to weigh quite heavily on the manufacturing sector?
Well, the challenge here is the export side, which continues being battered. We know that the South African consumer has had a lot of breaks, and we expect another 50 basis points later in the year. And therefore, maybe with the debt service costs coming down, we may see some improvement domestically. But however, the key for us through the MIDP is to push up exports. And with the problems in Europe and America, it's still a challenge. And I don't see that sector coming up very, very fast, except domestically, where we may see the consumer coming back to the party again.
Now, with the outlook for the current account deficit improving quite significantly, and this used to be quite the big issue for the rand going forward. Now that the outlook has improved, what does that mean for the rand? And considering that the rand has enjoyed significant gains over the past while and well below that 8 rand level?
It means tough times for exporters. You know, exporters want a very, at least a stable and a relatively weak currency that relates to the fundamentals. And the fundamentals indicate a weaker currency. Therefore, going forward, even though the rand may go up to closer to lower levels of 7 rand, it's not good for export because we need to be competitive. We need to make sure that we get the employment, particularly in the export-oriented sector. In the mining sector, it's critical for us to have a stable and a much more competitive rand. If it's not, as the signs are indicating now, it means tough times, and therefore it's very, very worrying.
The rand is currently at 7.68. Just taking a look at that figure, where would you peg the rand in terms of making our manufacturers competitive?
Well, we're looking at something around 950. We love 950 because, you know, we need to move forward. We cannot afford an unemployment rate of about 25%. Americans at 9%, our counterpart Brazilians around 13%. Therefore, we need at least to around 15%, and we can only do that through productive sectors that are labor intensive, and manufacturing is one of those.
Taking a look at other news that came out this week, quite interesting. A lot of talk about the National Health Insurance Scheme that could come to the fore. A big debate surrounding this, considering that we saw health insurers come out with results as well this week. We had Discovery and Metropolitan as well. Just taking a look at that debate, what sense are you making of this talk? And do you think that government can actually implement such a huge scheme?
Unfortunately, the sense I'm getting, Eleni, is that a lot of us, when we see national health insurance, we see the British system. There is another system in Canada which seems to work, and a lot of it revolves around funding, around turnaround in the public hospital. And in Canada it seems to work, and part of it was through funding via the value-added taxes. And in South Africa, we know that it's been a sticky point when we're trying to shift towards increasing value-added taxes, particularly from labor, because people believe that it will help a lot of the poor by increasing value-added tax. And many countries, it seems, to collect more efficiently through value-added tax because you pay at the point of the till point. Therefore, the debate here is going to be around how much the 20% that have access to private and better healthcare will suffer when we bring in the other 80%. And people are worried that we may see decline in standard, we may see people coming back from an operation with swabs inside their stomachs, and that's the picture people are seeing. So more debate, and I'm encouraged by companies like Discovery are willing to engage policymakers, and I think policymakers will have to come to the party. And I see a scaled down version between the British and the Canadian system, whereby they will foot the bill, there'll be some drop in certain standard, but overall be able to have a much more efficient working national health system.
Lumkile, we already have a growing budget deficit. How can governments afford this, and where are we going to receive the funds for such a huge scheme?
Government can't. That's why the value-added tax option will be probably more encouraging. However, whether government can sell it to labor, given the strength of the labor movement, it's another issue. But quite critically, we may need to have a long-term plan than quick, because there's too many demands. It's national health system, it's employment, so it's very challenging. Where are the priorities? So I think as much as government may want to implement it, probably it might come in the next 4 or 5 years as an implementation plan, because at the moment there's no money. We're looking at about $80 billion, rand, a shortage in revenue. So I think in the next 2 or 3 years, won't see it until the economy recovers and we start seeing huge revenues coming to government.
Price fixing has been under the spotlight in South Africa over the last couple of years, and now we've heard the Competition Amendment Bill has finally been signed into law. And this places company executives in very difficult positions. They could be held liable for price fixing. What do you make of that new law, and do you think that perhaps they should have changed it in some way and said, okay, until this date you have time to ensure that you aren't involved in any dodgy dealings?
Well, for me, it's very encouraging because it puts a lot of pressure on management to understand what's happening at lower level. Secondly, at board, because most of us sit at boards, we don't ask those questions about, how we are pricing, because we're not looking at trying to satisfy shareholder returns, because shareholders want a high dividend all the time, but without looking at whether we're doing it cleanly, we're being accountable to the citizen, because all companies, we need to be accountable to citizens. In South Africa, competition is a big issue. We know that if we had competition, we'll have lower input costs, and South Africa will be very competitive and will bring...
Do you think this will keep foreign investors away?
It shouldn't. Foreign investors are used to. I mean, the European Union is very good. The European Commission has got an excellent oversight role. But so we've seen with Sasol around the candles, how they were fined. So I think it's going to bring discipline, it's going to bring accountability and transparency, but more empowering to the consumer and the smaller SMEs there who feel the brunt of price fixing because they're the end of the stick.
Of course, Tiger Brands and Sasol paying quite a hefty fine for price fixing there.